Welcome back to Morning Trade Live. It's time to go inside out on AMD following the company's earnings. It's up about 2.5% right now as we speak. And joining me to talk about this name, Angelo Zino, Senior Equity Analyst at CFRA Research. Thank you so much for being with us. Your thoughts, I mean, everybody loves Lisa Su. I mean, I'll start with that. Your thoughts on the AMD report?
Yeah, so thanks for having me, Nicole. I'd say, results overall were pretty good, right? I mean, Q1 results were in line to slightly ahead expectations when you look at both the top and the bottom line. I think even margins were marginally better than what we expected on the Q2 guide as well, roughly in line with our expectations. I think what Lisa Su did really well on this call was she highlighted the risk tied to China, and she actually put a number on what that risk was. And really what this market wants to see is some visibility across, specifically the semiconductor industry, where visibility is extremely low. And I think she did a good job really providing that. She highlighted the fact that there's about $1.5 billion of revenue risk this year. That equates to about 5% of their revenue, where it's really going to hit hard in Q2 and Q3. Really, all of it is going to hit in Q2 and Q3. And then we're going to start seeing some better momentum as we kind of go into Q4 and into 2026 on their GPU server side. And that's really the story for AMD right now, is that data center business.
Right. And, one of the things that we were talking about for NVIDIA coming out on May 28th was how many chips did it in fact sell to China with the new regulations that it faces. And so that's what I'm really hoping for, more clarity when it comes to AMD, NVIDIA, the amount of chips they're selling, the demand for the chips, how that flies for 2025. And you had Huawei stepping in and filling in the holes pretty easily, right? And that could be problematic if these companies get very used to the Huawei chips. Then they won't need the NVIDIA chips or AMD chips.
Yeah, no, I think you make a great point. I think, when you look at the China market right now, we're essentially wiping out most revenue in China for both NVIDIA and AMD. We're looking for, very little revenue to go into that region. Clearly there are going to be conversations that are to be had between the US government and China. The hope is, maybe we start getting better clarity on that side of things. Maybe, AMD and NVIDIA can find a way to return and see greater momentum into China. But right now, I think, I think the visibility looks very low. And I think this administration looks a lot different and a lot more aggressive in terms of how they want to handle these leading edge chips into China right now. So we're actually expecting very little in China here for both AMD and NVIDIA over the next couple of quarters. But the hope again is, maybe some of that returns and maybe things start to ease a little bit. But yeah, I mean, it doesn't look good as far as China is concerned for either of those companies.
And you do have a buy rating, right? And a price target of 140. Is that correct? It's at 99 today.
So we actually lowered our target price to $125 from $140, and really, we tweaked our estimates down a little bit. But at the end of the day, this is a company that's based on our target price would imply about a 21 PE to our 2026 estimate. And I think more importantly for the AMD story is going to be 2026. They just announced or completed an acquisition of a company called ZT Systems. As they go into 26, they're going to roll out something called their MI400, and that's going to be based on these large-scale rackable systems. And that's going to allow them to really help close the competitive gap with NVIDIA, and it's also going to significantly increase the potential on the data center server side of things. So we like the prospects going into 2026. You just have to get through the next couple of months and quarters with the uncertainty tied to geopolitical pressures.
And you still have the buy rating, but you lowered the price target. It's the same for, just before I leave this story, I got to get to ARM. But NVIDIA, do you also have a buy rating?
We do have a buy recommendation, and it's our target price remains 165.
Okay, good to know. Thank you for that. What about ARM? Yep. Where does this story stand for you, ARM Holdings, tomorrow?
Yeah, I mean, so ARM Holdings, it's interesting to see kind of what they have to say. I think the March quarter results, the June quarter results will be perfectly fine, just given what we've heard across the industry here over the last couple of weeks. I think it'll be interesting, given that the March quarter is typically their year end, and what they did last year was they provided full year guidance for the year ahead. It'll be interesting to see whether or not they do that again. If they can continue to demonstrate 20% plus growth on the top line. And again, this is a higher multiple name. We're talking about a multiple, about 45, 50 times next year's earnings. If they can provide that type of detail out there, that'll soothe some of the concerns out there for investors. Maybe you see them reiterate that target, but more of a wider band for their 2020, fiscal 26 outlook, given the uncertainty that's out there.
So I'm going to make them very short, because it's actually two questions. One, any names in your coverage, the names that you cover that you definitely think are the buyer strong buy, maybe name one or two of those. I always like to share those with our viewers. And do you think that we will see a recession?
Yeah, I mean, as far as the companies with the best visibility, I'd say on the semiconductor side of things right now, I'd say Broadcom's got the best visibility. We expect them to report, in a couple of weeks, and we think the visibility there is going to be very good. Obviously, they've got that 40% of their revenue is tied to software. But even on the semiconductor side of things, they're winning some really big business that's going to ramp over the next 2 years or so. So if you see a pullback on Broadcom, that would probably be our favorite name to buy right now. And NVIDIA, we do think there's a lot of uncertainty and concerns tied to the name right now, but we would still be buyers of that name, just given the free cash flow potential of the company and the U.S. exposure that they have there, and de-risking on the China side of things. And do we think we're going to see a recession here? I think that's a great question. I think it all depends on where policy goes. And I think you can essentially throw a 50-50 out there. But the hope here over the next couple of weeks is we start seeing some deals announced, and really some kind of, I guess, easing on the China side of things, because that's the real story, not only for the broader market, but especially for semis and the tech space right now.
All right, Angelo Zino, great to see you on this Wednesday morning. Thanks for the coverage on these key names during earnings season here. CFRA, Angelo Zino. So let's trade it now. Tom White, host of Fast Market, is here with us, and he'll take us through these two names, looking at AMD and ARM. So you have an example trade first for AMD.
Yeah, Nicole, implied volatility levels have really been crushed post earnings. The stock's basically unchanged right now, just above 99 bucks a share. So I looked at a strategy that if you think this thing's going to go higher over the next, maybe month and a half, give yourself a little bit of duration. You can buy cheaper verticals in this based on the fact that implied volatility levels are really a lot lower. So I looked out in the June monthly cycle. That expires on June 20th. So 44 days to expiration on this example, where I'm going to buy the just out of the money 100 strike call, and then against it, because I want to offset some of my costs on that bullish call purchase, sell the 120 strike call. So a bullish $20 wide call vertical. You're going to pay roughly, I've got about a $6.50 debit. That's where it was trading earlier. Trading closer to $6 right now, so you can get it a little bit cheaper. But if you pay that $6.50 debit, it takes your break even up to $106.50 over the next month and a half. That's about 6% above the current share price in there. So you don't need a big, giant move in there. You just want it to kind of grind higher. And by buying verticals like this, you're offsetting some of the costs on the initial purchase of the call by selling a call above the current share price. But then also it gives you some flexibility as far as trade management goes. So if you see a pop in AMD, maybe they have news out in 2 weeks or 3 weeks, it gives you some opportunities to maybe close a portion or all of your trade if this thing expands in price. But you definitely need a move to the upside to get above that break even. But this might be the way to play it, giving yourself a little bit of duration, taking advantage of that lower implied volatility that lowers the entry point price on this bullish call vertical.
Okay, thank you for that. The bullish call vertical there on AMD, which actually has been losing some momentum. It had been up over 2.5% today. Now it's down about 1.1%, still holding on to some gains. Let's take a look at ARM Holdings. Now you just heard Angelo Zino talking about ARM and talking about some of these names and giving us a preview for tomorrow. Your thoughts and your example trade.
Yeah, the option market pricing in about a plus or minus $10.5, $11 move either way in the shares on this name. And if you take a look at it, it's still up over about 16% over the last 12 months. So it's done okay, but it has pulled back, basically flat this year. So I looked at a strategy that takes advantage of maybe that one standard deviation move that the option market's pricing in, that plus or minus 9% move in the shares, or roughly about $11. And I looked at a double calendar position. This takes advantage of the vol dispersion between the option series that you're buying and what you're selling. So on the put side, we're going to buy a 1 week wide put calendar here, where you're going to buy the May 16th 112 strike puts. That expires in 9 days. Sell that same 112 put in the near term May 9th weekly options that expire in just a couple days. And then on the call side, we're going to buy the 132 strike call in the May 16th weekly or monthly options. Sell that May 9th weekly options on that same 132 strike call. So in essence, you're buying an out of the money call calendar and then buying an out of the money put calendar. As a combination, you're going to pay roughly about a $2 debit for this double calendar position. That's going to be your risk, $200 per spread. But you can see here from the risk profile, you want the stock to either go at or near 112 or at or near 132. But you've got a nice wide range of about between about maybe $105, $106 on the downside and about 140 on the upside, and you can still potentially remain profitable. The key here is the low entry point price and risk price on this is because you're buying a cheaper implied volatility in that May 16th option series, where you're buying the 132 call and buying the 112 put, than what you're selling. It's got a really higher implied volatility level in that May 9th options where you're selling those same strikes. So double calendar position might be the way to play it if you think it's going to get that, maybe that one standard deviation move. You just don't want it to move, 2 or 3 standard deviations to the upside or downside, or you don't want it to kind of remain where it is, about 121 right now.
So thankful for you, Tom White, with your example trades here with Inside Out. And you can catch Tom later on Options Corner on the watch list with all of these trades. Thank you. Those are real trades that you find in that case. Tom White, thank you.